We go across to George Joseph in just a minute. He's the CIO, CEO, equity at ASK Investment Managers. He's going to join us on the other side of this very short break. George, hold on. We'll just come straight to you post this break. Welcome back, and we're joined by George Joseph to continue conversation on how he's viewing markets. George, we've seen a bit of a rebound. You believe this can stay and that valuations looked oversold at one point?
Yes. If you look at the last 1 year, what we have been telling our investors is that the valuations look very stretched, especially in the mid and small segment, and that has been continuously being communicated into various commentaries that we have released, as well as what we have been telling the investors on various, and also on your channel as well. The typical problem is it's seen as the US is in a very fragile environment because the debt levels are high, fiscal deficit is high, current account deficit is high. Any country who had this kind of context, the currency has not behaved well. And all these issues, what we are seeing around is mainly, US trying to find a solution to that bigger problem. But, that is not going to go away very easily. So that fragility remains, but the valuations have corrected reasonably well in India. So what your point, many stocks are oversold, many sectors seem to be significantly beaten down. So we are extremely positive at this juncture and telling investors this is the next 3 months, aggressively you can look to allocate money to equity as an asset class.
Interesting. So, George, in terms of the allocation itself, is there a change in strategy versus 1 month ago? Because circumstances are markedly different. I'm trying to understand whether there's been absolutely any change in sector or allocation or preference over the last month or so. I'm sure there is.
Yeah, so obviously the preferences are, definitely changing, and the prices are changing, right? So some sort of, we have been telling our investors, as well as when we are constructing the portfolio 1 month back, when I joined ASK and when we are meeting our investors, what we are seeing is that the cyclical basket, is looking very, very attractive. And within that, banks were looking extremely attractive, banks and financial services. And that has played out to a certain extent in the last 10 months, where banks have moved up and, with the EMS and various other sectors, which we were very uncomfortable in terms of valuations we were selling off, those have corrected massively. So preferences have been changing. But, if you remember the context at which the entire cycle has started in 2020, the inflation, interest rates moving up from almost zero and to where it is today in US. And, that is the change in the market structure which has happened from 2020 onwards, and that still remains. So we are more pro-cyclicals. Now IT has corrected massively. So IT is looking a very good bet, could be a defensive bet as well as a good cyclical upturn bet from my perspective. And also what we are thinking is that, capital goods, engineering, utilities also will be in the radar. Let's understand things, right? So energy as a basket will be higher is the base case assumption that we are building in post these changes, what we have seen in the markets. But the prices of many stocks have corrected meaningfully well. Like Nifty 50 stocks itself is down 12% in a month, which means that, you are going to make 20% more return, right? So to catch up to the same price where it was earlier. So the return potential of the market has increased substantially from the current levels. And we believe that the micro cap segment as well as the Nifty 50 segment is looking the most attractive to me.
Interesting. Okay. George, in terms of damage, there have been certain sectors which have seen far more price damage than others. Do those suddenly look more attractive versus what they were a month ago? Any sectors which stand out?
So a couple of cyclical sectors which has been beaten down to dust. say, for example, construction, it is gone out of the oblivion. Today it is most of the names in the construction sector is a micro cap stock. And, that is a sad part of the affairs. So if you look at construction, then real estate, for example, has been beaten down to dust. So which again, we are becoming more constructive. There are very high quality names available there. And inflation protection is the theme that people are playing from 2020 onwards. I think this is a good hard asset, which you can get. And those stocks have been significantly damaged in the last 6 months. And if you look at what is the geopolitical situation telling us, specifically from the Middle East, the Middle East real estate was zooming. Now, probably that will take a part of the money which was flowing outside India, specifically for Dubai real estate, maybe coming back to India in some shape or form. And also on the other side, gold and silver, where people have allocated massive amount of money. When you look at the ETF flow data, which suggests that that also has gone into a parabolic move, and which again, the money will move out of that. So where this money can move, according to us, it will move to real estate and also to equities, and which is becoming more attractive at this point in time.
George, one can safely say that about some of the large private banks as well, right? Including the ones which are, the troublesome ones right now. Anything that you may have bought in this, massive selling which has taken place within the Nifty Bank constituents?
Absolutely, absolutely. So if you look at our constant endeavor, and also have been telling in the media as well, last 8-9 months, I've been on record. We have been saying that the large private banks is looking very attractive. It's at a 5-year low valuation. You are getting many of these names. Probably you might not get these valuations henceforth. And, again, the different issues and noise which is creeping up, which that, these are the times where these price points, because the holders are running away, and, the valuations anyways becoming cheaper because of FI selling and various sort of activities, market participant activities. But at the same time, your ultimately fundamentals are intact, valuations are becoming cheaper and cheaper. That's the point where, as fund manager, to me, it is a music to my ears, because as the price keeps coming off, it becomes extremely rewarding for our investors to dip in. So we have been a big proponent of private banks, large private banks. It has not worked the way we have thought, but we think that it is a brilliant opportunity to dip in.
Where else are you finding this kind of, pricing attractiveness or valuation comfort, where, while the stocks may not run up in a hurry, but you don't have much to lose? Would you say the same about IT, for instance, George?
100%. So if you look at the IT sector as a whole, we are more into IT services business. We are not into technology, the so-called technology, Silicon Valley technology business. So any kind of, like, say, for example, the GPUs or the chips prices crashes if China comes up with a 1/10 the cost of a chip, which probably other companies in US is making. We are not affected, right? So the IT services business, as we understand from all the experts we spoke to, stalwarts of IT sector in India, what we realize is that, and we manage many of their personal money as well. So what we realize is that that sector is what people are estimating in next 6 months to happen. It will not happen in even 6 years. And there is a huge opportunity which is coming up through the AI-driven business model, which people are not able to visualize at this point in time. People are all worried about the repeated jobs going away and the billing going away. But we are very constructive on the sector. And, it's a big overweight for us. In this fall, we have been a buyer of all the large cap IT names where the valuation is significantly cheaper.
Very interesting. George, just, trying to get the rationale, because a predominant part of the revenue of some of these IT services companies comes from man hours. Now, that is likely to shrink, right, in a significant fashion. Given AI, coding is going to be more AI driven, which means the man hours will shrink. Do you believe that they're going to pivot on the business model and the top line, therefore, will undergo some flattening over a prolonged period? How should one look at things? What's keeping you positive with regard to the evolving business model of the IT companies?
Right. So, all these companies have gone through various technology challenges in the past. If you see the last 25 years, I've been in the markets for almost 35 years, monitoring various companies, from a very young age. And last 25 years in the professional capacity also, I've seen many of these companies adopting various, like be it digital transformation, be it infra cloud migration, changes. Various changes we have seen in the past, and the companies have been able to adapt and quickly create a value proposition for clients, because these guys are extremely deeply interconnected or deeply linked with the clients. And for implementing AI also, if at all that is in need of the hour, these companies are definitely going to help the business out to to adapt and move to the AI infrastructure. So I see very clearly a one-time opportunity of moving to AI-led consulting as well as business model. Definitely our revenue model is developing, but at the same time, the existing business also, it will become more efficient. And, with the AI adoption done for the repetitive jobs, which means that, the company's margins also can potentially look up. Mind you, one of the largest, the bellwether in IT sector, the last quarter has upped their guidance, and after that, the stocks have fallen 20%. So when you get these kind of opportunities, when we see that these companies are capable enough to shift to the new dynamics of the world of AI, what we are looking at, and I think it will become as a very positive surprise going forward, because as we understand, these companies are catering to the technology service part of it, where the more and more usage of technology means more and more usage of the technology services as well. So we are quite constructive at this point in time.
Okay, all right. Thank you so much, George, for joining us and giving us that perspective. It's a good time to kind of sit back and reflect, and I think you've given us enough food for thought to do exactly that.
Thank you. Thank you.
Well, viewers, what we'll do is slip into a very short break. We'll continue coverage. Start talking stock specific, because there's plenty of some big movers here. Start taking some views even from Kunal on the other side. Stay with us.